have described a very difficult environment with a lot of potential for risk and instability. How, as an investor, how should we think about positioning for something like that?
My main things are first, cash is trash, um, and that there's in bonds and debt, it's not going to be good, and the claims of financial assets. So either avoid those or position yourselves so that when those things operate and position yourself for inflation. So there are investments, lots of investments pertaining to inflation. I agree with Jeremy's comments about commodities, and the big commodity cycles are reactive. There's a giant, just like the 40-year bull market in bonds, associates with a commodity cycle where everybody adapts to that. Companies don't hedge. Inventories are drawn down. There's less investment in those things. That when that switches to that kind of an environment. And the big overarching thing is that the amount of financial claims that exist, and there's charts in my that I repeatedly show when I deal with the changing world order. What is the amount of financial claims, assets, relative to real assets? And you could see that through history, when those financial claims, it's like a bank has too many IOUs on its real money and that thing, then you always get into these environments where it's undesirable to own the debt and you have negative real returns. And so to position one's portfolio in a tilt that way. But of course, the way that we do it is to separate alpha and beta, right? So two parts, core, because we're all talking tactical. How do you create a truly well-balanced core portfolio? And we know that the typical well portfolio is not well balanced, with its greatest vulnerability being in that upper right quadrant in our box, which is the inflation box. And we know that we're in that environment. So from a starting point of view, I would encourage all investors to look at that box, those four quadrant box, that box that we have: rising inflation, falling inflation, rising real growth relative to discounted, falling real growth relative to discounted, and see what the biases are in those portfolios. I believe that now you can simultaneously reduce risk and raise returns